Now, let me ask, are there certain restrictions with certain lenders, or is it just that's kind of the common thread amongst the community?
Okay. Yeah, absolutely. So now each lender can put on their different overlays and their different requirements for that particular lender. That's why I always ask my clients to go ahead and fill out an application with at least two or even three different lenders so that they can understand the different options, products, and programs. Because you may see all the lenders are offering a VA loan, right? They all have that product in their arsenal, but some lenders may have different overlays and different stringent requirements as far as putting a minimum credit score and not looking at work experience the same way and a lot of different things. Even we have veterans that want to actually buy land to build homes, right?
Yeah.
And definitely most lenders don't cover that with the VA loan. So if you ask a lender that don't have that particular product, they'll tell you no, and you will think you can't do that with the VA loan, and in fact you can.
Oh wow, yeah. And I think it's really a real good point to stress as well that a lot of these requirements, they're not because of the VA, right? The VA is more or less looking to make sure that the veteran is kind of pushed into the home and put in a good home for your family. But they're not trying to prevent you from getting into a home or getting the loan for necessary fact. They're mainly making sure that you're protected because again, the home purchase is one of the largest purchases that you're ever going to make in your life for the most part, right? But another thing as well is again, regulations are also in protection of, and I think a lot of lenders that you would necessarily want to get information from or get a loan from, make sure that they understand the VA loan, right? I think that's a huge component as well.
Absolutely. Very, very much so a huge component. So you want to make sure they understand the VA loan, and you just want to make sure that you stay educated on what your options are as well. And another point that we want to cover here is just what type of income qualifies, right? So let's say you're married, okay, and you want to utilize your spouse on a loan, or even if you aren't married and you want to buy the home with somebody else that's occupying it, you can go ahead and actually put them on a loan as well. If it's a girlfriend, I don't know if I personally advise it, but it's an option, right? You definitely have the option to do so, and you can add that income. But some other income that you might have is from any service-connected disability benefits that you're receiving, right? And that income is very good because they're not taking taxes out of that, right? So you're getting that full amount, and also there's no minimum vesting time. So what I mean by that is that do you have to receive that for 1 year, 2 years? No. The day you get out and the day you actually are awarded those benefits, your lender could actually utilize that towards your calculation for your debt to income ratio.
Let me back that up a little bit because as a veteran myself, I want to kind of understand that, right? So if I'm a veteran and I have transitioned out of service and I am currently in school with a job on the way of that time that again, my work history from school and also my work history from the military, but I receive my disability benefits. So you're saying that they would, because from my understanding, you would need a little bit of time at that job before utilizing that income. So you're saying your benefits, you don't need that time?
The benefits, you need 0 time with those benefits. So
oh, wow.
As long as you're receiving those benefits, you have that award letter, you can go ahead and show them that. Even before you actually got that first deposit, right? Because on there it'll show the amount. And then of course, once you get that, you would just show them the direct deposit or the check thereafter and where it came from. And as long as they know that's a permanent entitlement, they'll definitely be able to utilize that. So in those type of situations, let's say you're 100% service connected, you might be getting a hefty amount monthly, and you may be able to qualify for a home purchase depending on the price of the home, just utilizing those benefits.
And kind of, going back to that is again, because most isn't, at that that rating or decision, right? I think even if you're 30%, 50%, that is still a pretty good amount that you can go utilize towards a home purchase. So definitely with the rising interest rates, but also as we talked about in other segments of our shows, that the benefits are also rising as well. So now you can kind of almost offset it, right?
Yeah, absolutely. And understand that number is kind of grossed up in a sense, right? Because if you're thinking about, let's say you get $2,500 a month, right? And somebody else has a job where they're making $2,500 a month. Well, they're not bringing home $2,500, right? They have taxes that are going there. They have insurance, different things of that nature. They might only be bringing home $1,700 from that. You're bringing home that whole $2,500 from that payment. So that factors in there, and that's that can lead to significant increase in the home that you can do when you combine that with your income and or your spouse's income.
Wow. Listen, that's just knowing so many people that have attempted to purchase homes and just had many bad experiences, and there's just so much content out here when we're talking about bad experiences with the VA loan or just with any loan product. That's just valuable information. So when we're talking about consideration, that's all. Again, I know you mentioned that that you take your buyers always kind of navigating and making sure that they understand to go through the process of shopping lenders, right? But could you elaborate on why you do that?
Absolutely. Great question. So I do it for a few reasons. One is that different lenders are going to have different products, programs, and then overlays. So for example, you may be a business owner, and some lenders may look at your income and they're like, hey, the loan is too risky for us. Or they may look at your debt to income ratio and say, it's too high for us, right? But it's not too high for the loan product. It's just too high for them to feel confidently in taking on that loan product. So they just won't do it. So I do it for that reason. Also do it for the benefit of just shopping interest rates, right? Because when you actually force lenders to compete, they prepare to compete, just like the podcast says, right? Because if you only get one lender that you're working with and they tell you this is the interest rate and you don't shop around, well, they may have not gave you the best that they could, right? Because ultimately, they have a job to do. They're trying to make as much money for their companies as they can as well. And it couldn't even, it's not even just your particular lender. You got to understand it's the whole corporation, right? So once you actually say you have a lower rate from a competitor, then now they can go into their supervisor and say, hey, we're going to potentially lose this client. Is there anything else we can do to keep them, right? And they'll try to go through the motions and do whatever they can. So you might enter that scenario where one lender told you 7%, and then other one said 6.5, and then you go back, and then the 7% say I could do 6, and it's like, do I got 5? And now it's like a whole bidding war for your business. So that's another reason why you want to do that. And then oftentimes the third reason, it gets a little bit more complex, is that there's different types of lenders, right? So you have lenders like your Wells Fargo's, right, and your even Navy Federals, which is a small community bank. They often they have their different risk levels, right? And then you have regular brokers, right, which is very good to work with the broker a lot of times because they're shopping your loan with their different companies that they work with, right? So if you go to a broker, they're pretty much going to shop you around to 3 to 5 different providers anyway. So I usually tell my clients to go to a broker, to go to a credit union, just a regular credit union, local credit union, and then also look at like your Navy Federal as well, credit union, because they usually have a lot of favorable programs and rates as well. But then if you have like a particular lender that works for a particular company, shop them in there. But the main two that I want to make sure that you pursue is going to a credit union, any credit union, and going with the actual mortgage broker. So you want to ask your lender, like, hey, are you a broker? Are you shopping my loan for the best rate, or is it just your company doing in-house financing? Because some companies do the in-house financing themselves, and then they might sell it off or whatever, but they actually fund the loans themselves. So now they could have less overlays and they have more creativity on things that they can do, because they can get the loan closed and they actually worry about selling it after closing.
Okay. Yeah. So basically what we're saying is that, or what you're saying is mainly make sure we shop around for lenders, but sounds like one major corporation, broker, and more or less almost a credit union or local bank to kind of be able to get the best products.
Absolutely. Those are going to be your 3 tiers that you want to go to. And, again, they're going to have different options. You want to definitely like and respect the institution that you're working with, but also